You've probably heard a CEO on an earnings call bragging about their company's incredible EBITDA, and maybe you just nodded along, wondering what on earth that actually means. Well, it sounds super complicated, but it's one of the most important and, believe me, most controversial numbers in business today. So let's just dive in and demystify this thing once and for all. All right, let's imagine two companies. On paper, they look like twins. Company A and Company B both made a net income of $1 million last year. Now, if you only look at that bottom line, you'd think they're in the exact same boat, right? But hold on. Company A is saddled with $10 million in debt, while Company B is totally debt-free. So which business is actually healthier? That simple net income number, it just doesn't tell us the whole story. We need a different tool, something that can look past the accounting and see the real engine humming underneath. And that, right there, is why EBITDA exists.
To really get to the bottom of this, we have to go beyond that bottom line. We need a way to get a clean, unclouded picture of how well the business is running its core, day-to-day operations before all the financing decisions and tax strategies get in the way.
And that brings us to EBITDA. The acronym stands for Earnings Before Interest, Taxes, Depreciation, and Amortization. Yeah, it's a mouthful, I know, but its job is actually pretty simple. It's designed to measure a company's core operational profitability. It's all about getting that clean picture of how much profit the business makes just from doing what it does.
So how do you get there? The formula itself is pretty straightforward. You start with the company's net income, that bottom line number we started with, and you simply add back the expenses for interest, taxes, depreciation, and amortization. But the real question is, why on earth would you add expenses back into profit?
Well, let's start with interest and taxes. We add these back because they don't really tell you how good a company is at its actual business. Interest costs just tell you how the company is financed. Did it borrow a ton of money? And taxes just depend on where it's located. By taking them out of the equation, you can finally compare two different companies on a level playing field. It creates a true apples-to-apples comparison of their core operations.
Okay, so what about depreciation and amortization?
These are what accountants call non-cash expenses. Think about it. A company buys a huge factory. They don't expense it all at once. They spread that cost out over many years. But here's the key. The cash already left the building years ago. So adding these back helps us focus on the real, actual cash performance the business is generating right now.
Now, understanding that basic formula is a great start. But in the real world, the world of private equity and high-stakes M&A, the pros almost never stop there. They use a kind of supercharged version of the metric, which brings us to our next point.
See, professionals use what's called adjusted EBITDA. And the whole idea here is to get an even cleaner look at a company's true, ongoing, repeatable profitability. You do this by stripping out any weird one-time expenses that might throw off the numbers. This is the figure that multi-billion-dollar deals hinge on.
The process is actually pretty logical. It's like building blocks. You start with net income at the bottom. Then you add back the ITD&A to get to your basic core EBITDA. And then you take one more crucial step. You add back any of those unusual one-off costs to get to the holy grail, adjusted EBITDA.
So what kind of stuff gets added back? Well, it could be a whole range of things. Maybe a massive one-time legal settlement, or the huge cost of a complete software system overhaul. It could even be an unusually high salary that the owner of a private company pays themselves. The whole point is to paint a picture of what the company's earnings would look like in a totally normal, boring, repeatable year.
And why is this so critical? Because this adjusted normalized number is the absolute bedrock of company valuation. When a big firm is deciding whether to buy a company for hundreds of millions of dollars, this is the number they are looking at to figure out its true earning power and, ultimately, what it's worth.
Okay, so EBITDA sounds like a pretty brilliant tool, right? A clear, standardized way to judge a company's health. Well, not so fast. Some of the smartest investors on the planet think it's one of the most misleading and dangerous metrics ever invented.
And that brings us to this legendary quote from Warren Buffett. He says that any mention of EBITDA makes him shudder. And then he asks this absolutely brutal question. Does management think the tooth fairy pays for capital expenditures? Whoa, this is a huge shift in perspective, and it points a giant flashing arrow at the metric's single biggest flaw. And here it is. This is the central, most important criticism you need to understand. EBITDA is not cash. It is not a substitute for cash flow. It's not even close. And confusing the two is an incredibly dangerous mistake. You can have a beautiful, growing EBITDA and be just months away from going bankrupt.
Just look at this example right here. Company Z is bragging about its $10 million adjusted EBITDA. Looks amazing, doesn't it? But then you look at the actual cash that came in from its operations, and it's only $1 million. And worse, look at what it had to spend on new equipment. That's capital expenditures, $3 million. So when you do the real math, this company actually burned through $2 million in cold, hard cash.
So what's EBITDA missing? Two gigantic cash-eating monsters. First is capital expenditures, or CAPEX. This is the real money you have to spend just to stay in business, to maintain your factories, upgrade your computers, and replace your trucks. Think of it this way. EBITDA is like bragging about your car engine's horsepower while completely ignoring the cost of gas, oil, and replacing the tires. Buffett's whole point is that the tooth fairy isn't paying for that stuff. It also ignores changes in working capital. That's all the cash that gets tied up in things like unsold products sitting in a warehouse.
And there's one more big risk. Because EBITDA isn't an official government-mandated accounting rule, it's what they call non-GAAP, there are no strict rules for what can be called a one-time expense. This opens the door for a lot of, let's call it creative accounting, which can make a company look way more profitable than it truly is.
Okay, so we have two totally different takes on this. On one side, EBITDA is an essential tool for comparing companies. On the other, it's a deeply flawed metric that ignores real-world costs. So, what's the verdict?
Let's just break it down. The big pro is that it's fantastic for comparing the core operational profitability of one company versus another. The huge con is that it's a terrible way to measure how much cash a single company is actually generating, because it pretends some very real costs just don't exist.
So here's the final verdict. EBITDA is a specialist tool. It is incredibly powerful and useful when you use it for its specific job, comparing businesses. But it's incredibly dangerous if you misuse it and think it represents cash flow. You absolutely have to understand its limitations.
At the end of the day, EBITDA tells you part of the story, but it never, ever tells you the whole story. So the next time you see a headline about a company's amazing EBITDA, you'll know to dig a little deeper and to ask the one question that really matters. Is this company actually earning cash, or is it just burning it?